Did you know that 80% of retail traders lose money over the long run? It's crazy when you think about it. I can't find another activity where 80% of the participants fail. But what if I told you that the vast majority of them make the same mistakes over and over again? In this video, I'm going to tell you the 10 most common mistakes that losing traders make. And it's not going to be the same old vague stuff you've heard 100 times before, like, oh, they put their stop loss too close, or they don't follow the trend. No, it's gonna be stuff that we rarely hear about, but that really makes you think. So let's start with mistake number 1. Not understanding the role of luck and bad luck in trading. A lot of traders think that results reflect their level of skill, but luck, good or bad, can play a huge role in results for a long time. Imagine a strategy that has a negative expectancy. So for example, a strategy with a win probability of 50% and a win-loss ratio of 0.9. So clearly a mathematically losing strategy. Yet if I simulate 20 curves of traders using a strategy that has these stats, you're gonna see that after 100 trades, half of them are making money and half of them are losing money. Even though all of these equity curves come from a mathematically losing strategy. You can even see like one trader at the top crushing everyone else, though he or she is using a losing strategy. So yes, it's entirely possible to have positive results and even very good results over a fairly large number of trades despite using a losing strategy, just because, well, luck smiled to you. The danger for these traders is believing that they found the method, which might lead them to increase their position sizes or take even more risk. And that's until eventually, well, luck will turn around. The reverse is also true. Using a mathematically winning strategy, for example, with a win rate of 40% and a win-loss ratio of 2, which brings like a very profitable expectation. While using that, some traders after 100 trades might barely be making any money or even still be at a loss. So even though on paper their strategy should win, in reality they have nothing to show for it. And when they see a catastrophic start where the capital just seems to go down, which is actually simply because of bad luck and a bad losing streak, they give up thinking it doesn't work, without even knowing that they were actually sitting on a potentially very profitable strategy. Understanding this reality, completely changing the way trading should be approached. You stop judging a strategy after 10, 20, 30, or 40 trades, but instead truly judge a strategy after hundreds, if not thousands of trades. In short, one shouldn't confuse skill with luck. Mistake number 2, not understanding the relationship between win rate and win-loss ratio. This is one of the most widespread mistakes amongst losing traders, who focus only on win rate. You hear, this strategy wins 80% of the time, but that number alone means absolutely nothing. What matters is the combination of win rate and reward to risk ratio or win-loss ratio. Even a strategy that wins 80% of its trades can still be a loser if its losses are way bigger than its gains. One should also know that the higher the reward to risk ratio you aim for on a trade, the lower the probability of success for that trade is. And the effect that lowering or increasing the reward to risk ratio has on win rate is inevitable. So when traders aim for risk to reward ratio of 3, 4, 5, 6 plus, they should know that by doing so, they greatly reduce the probability of a trade working. Therefore, they expose their strategies to longer losing streaks. By default, a random trading strategy that aims for 1-to-1 win-loss ratio will have a win rate of about 50%. A random trading strategy that aims for 2-to-1 win-loss ratio will have a win rate of about 33%. So the more you increase or decrease the reward to risk ratio that you aim for, the closer you're gonna get to these kinds of win rates. In other words, by lowering the reward to risk ratios, you naturally increase the win rate of a strategy. So if a trader has a very hard time psychologically handling consecutive streaks of losing trades, the first thing that they should do is probably aim for lower reward to risk ratios. Now, mistake number 3, ignoring the impact of fees and spread on a strategy's performance. This is a decisive factor, especially if you day trade or scalp on minute-based timeframes. Imagine a trader trading gold on a 1-minute time frame and putting their stop loss at $1.6 or 1.6 euros, but the spread itself is already $0.8. By doing so, because of the spread, they're starting at a huge disadvantage. The reward to risk ratio on that trade is skewed even before the market has started moving. They'll get stopped out much sooner and they will get TP'd way later than the price movements that they see on their chart. Over time, such spreads and fees will eat away at a strategy's performance, kind of like that roommate who kept borrowing our snacks one at a time. What looked profitable on raw backtest or on the charts can clearly turn into a loser once you start including fees and spreads on the live markets. Mistake number 4, constantly changing strategy. A losing trader is often searching for the perfect method. They test a strategy for a few days or a few weeks, and as soon as the results don't meet their expectations anymore, they switch immediately. And this is called strategy hopping, jumping from one strategy to another. The thing is, no strategy, even excellent one, works all the time. Every strategy will go through slow or losing periods, and that's completely normal from a statistical point of view. By switching too quickly, traders never accumulate enough trades to know if a strategy truly works or not. They keep starting over from zero with a new strategy, destroying all progress. And this is what's often called the trader's cycle of doom. Mistake number 5, feeling fear, thus cutting winners too early while letting losers run. This one is probably one of the most natural human behaviors and one of the most destructive for trading. Out of fear of seeing their unrealized gains disappear, many traders close their winning positions way too early. Or in other cases, they quickly move their stop loss into profit territory to not be able to lose anymore. On the other hand, when they are in a losing trade and price gets close to their stop loss, they move it farther away, hoping that price will finally reverse. This psychological bias is very much human. It's the reflex to avoid pain at all costs. A study analyzing tens of millions of trades actually showed that the average gain for retail traders is much lower than the average loss. To fix this bias, one needs rules and discipline. That means knowing in advance where to take profits, where to cut losses, and above all, sticking to it when emotions beg to do the opposite. Mistake number 6, not backtesting a strategy. Many traders enter the market with no idea whether their strategy has a statistical edge or not. They just apply a method that they saw somewhere and judge it after a few trades. The problem is that they have no statistical perspective on its reliability. A winning streak can give false confidence, while a losing streak can make someone abandon a strategy that was very likely to be profitable. Backtesting is the simplest and most effective way to check if a strategy has a statistical edge. It gives clear metrics to judge whether a strategy should be used live or not. Nowadays, with platforms like Upside, anyone can test a strategy in a few minutes without needing any programming skills. Trading live without previously backtesting a strategy is like sailing out at sea completely blindfolded. Many losing traders test their strategies live when they'd be better off backtesting every idea that they have, even if it takes months, so that at least they could get some concrete, hard data on whether a strategy is profitable or not. Now, mistake number 7 is a dangerous one. It's thinking in terms of how much can I make per month. Focusing only on potential gains is one of the most dangerous mindsets in trading. Many beginners think, if I make $200 per day, that's $1,000 per week, therefore $4,000 per month. This calculation, while tempting, is not based on anything concrete and pushes traders to take excessive risks to reach these numbers. Trading does not work like a fixed salary. Results will vary from week to week or month to month, and there will inevitably be losing periods. Focusing only on what you want to make leads to forcing trades or take excessive risk to reach an arbitrary goal. The real question is, how much am I willing to lose on a single trade? This amount, expressed in dollar terms or as percentage of capital, for example, 0.5%, becomes the basis for all decisions. Instead of chasing arbitrary, often unrealistic income, it allows you to build solid risk management and calculate position size on every trade, which then allows you to survive over the long run. And in trading, surviving and lasting long enough is what usually pays off. Mistake number 8, seeing each trade as a personal test. Many losing or beginning traders take each trade as a judgment on their intelligence or skills. If it's a winner, they feel smart and validated. But if it's a loser, they feel stupid, even sometimes humiliated, and their ego takes a hit. This emotional link between ego and results is very dangerous because it makes you want to be right instead of just following a strategy. In the book Trading in the Zone by Mark Douglas, he says something very relevant. Each trade should just be seen as one grain of sand over the multitude of trades that you will take over your career or your life. In other words, one trade does not define you as a person. It's just one point in the statistical sample of all your trades. The mistake many traders make is not detaching themselves emotionally from every trade. Less ego and more statistics is when real progress begins. The goal really is to follow a clear system with clear rules over the long run. Mistake number 9, listening to everyone. With the internet, content and information flow constantly, and trading is no exception. I'm telling you this while I'm making a video that's gonna be on the internet about trading. What I mean is every day dozens of videos, articles, and tweets present the new miracle method or strategy, or the new signal that you cannot miss. The trap many people fall into is trying what they just saw or heard, convinced that this time it's the one. The problem is, by changing direction based on the last opinion that they heard, all prior knowledge is usually discarded and gets thrown out, and progress kind of resets to zero. And this leads many traders right back into strategy hopping. It's fine to read or watch trading-related content, but every new ID must first go through testing before being used live. Don't follow blindly. Backtest to see what's worth keeping and what's worth discarding. Our trading capital, often earned through hard work, is way too precious to be an experimental playground for other people's untested IDs. At last, mistake number 10. Not being able to clearly explain a trading strategy. If a trader can't describe their strategy in a few simple sentences, they probably don't really have one. Many losing traders think that they have a plan, but in reality, they make decisions based on gut feeling at the moment. This kind of impulsive trading is impossible to reproduce consistently. One day they might trade a breakout, the next day they might trade a retest, without really knowing why one should work more than the other in a certain context. Without clear rules, results depend much more on luck rather than on a real statistical edge. Winning traders can precisely explain their entry, exit, and risk management rules. They know exactly what they are waiting for before clicking the buy or sell button. Having a clear strategy is like having a checklist before a plane takes off. It helps you stay disciplined even under pressure. If a trader can't simply summarize their method, it's probably time to clarify it before the market does it for them. Now, the good news is all these mistakes can be corrected, but it will require patience, discipline, and hard work. Successful trading is not easy, but every mistake you eliminate brings you closer to profitability. If you recognize yourself in one of these mistakes, let me know in the comments section. It would be very interesting to see which one comes up more often. And if you're working on fixing any of these mistakes, well, you have my full respect and I genuinely wish you success. If you enjoyed this video, feel free to like, subscribe, or comment. As for me, I'll see you in the next one. Bye.